Yeah, today we're going to talk about net present value and 5 other investment criteria for evaluating your capital investments. Assets define the company, and so it's very important to make good decisions when we're making major capital investments over time. And so we'll look at 6 different methods for evaluating your capital investments to try and make good decisions. And again, we want these assets to be more valuable than the original purchase cost of them over time. Method number 1, and the best method for evaluating capital investments with the least amount of negatives, is net present value. And we'll go over how to calculate each of these. Just remember that NPV is the most important and heavily used method, and so it's very important for us to learn it. Second, we have payback period, a very simple method that's been in use for many, many years, probably since the 50s. When does the CFO get her money back? If she gives you $50 million to invest in a major capital investment project, when does she get paid back? So a number of years. So payback period is in years. We can also do a discounted payback. Why don't we discount the cash flows and bring them, the cash inflows, bring them back to today, and see when we pay the CFO back. So we'll look at discounted payback method also. Average accounting return is average net income over average book value. So we can use 2 common accounting pieces of information that are readily available to calculate the average accounting return. Another very important and heavily used method is internal rate of return. What is exactly internal rate of return? The rate at which the NPV is equal to 0, or the rate at which my discounted cash inflows equals my initial cash outflow. So we'll look at IRR, very heavily used method. And finally, profitability index, which is used heavily in nonprofits and governmental organizations. It's kind of the bang for the buck, and what is the present value of cash flows divided by the original cost of the investment. So essentially, we'll have 7 learning objectives, the 6 methods that I just mentioned, plus how heavily are these 6 methods used in the practice of capital budgeting. First, NPV, the most important of the 6 methods. An investment is worth undertaking if it creates value. Here I have a sample product that you may have used. This is the Mach 3. Gillette owns a significant part of the wet razor market, and this was one of their prominent products in the scheme of things. They spent almost $1 billion developing this Mach 3. So they put a significant amount of money into this product. And will it ever sell one, and will it ever generate a good return, is something we have to look at. $300 million on marketing, $700 million on R&D. Many students receive this in the mail for free, one of these razor handles and 1 or 2 blades when they were 18 years old. Why? Gillette wants to build brand loyalty. So if this is a good product, you'll keep buying it and buying it, buying it. You know that your local Walmart or local drugstore, this may go for $8 or $9, $10, and it comes with 1 or 2 blades today. And then each cartridge in the new Gillette models may cost $3, $4, $5, $6 per. It's almost like the HP printer model, where the printer is given away for $100 and each cartridge costs $50 to $100 to replace color cartridge. So is this a positive NPV project is the question. Well, what should we price this product at, and what are the relevant cash flows, and so on? We must ask all these questions carefully. And will people like them? So from the Track 2 in 1972 to the Mach 3 in 1996, around 93 to 96 time frame, to the Fusion Pro Glide today, these are major capital investments, and they take years and years and years to develop. So we must look at methods to evaluate these investments. So NPV is the first one we're going to talk about. An investment is worth undertaking if it creates value. You may go into the housing business or construction business on the side, perhaps, in the evenings. And you want to know if you put some labor and material, buy some land and put some labor and material into it, will it be a positive NPV project? Here's an example here where we put $25,000 into some land. We put $25,000 into some labor and materials. And in the very short time, 3 to 6 months, we have a house built and we sell for $60,000. Is this a positive NPV project is the question. And the question is yes. In this case, in a short time frame, very little time value of money, we have a market value of $60,000, a cost of $50,000, an NPV of $10,000. Good investment. So the general rule for NPV is positive NPV accept and negative NPV reject. Basically, we go through this process by estimating the initial cash outflow, which we have a pretty good handle on, and then we estimate the future cash inflows, and then again discounted cash flow analysis, taking these back to today to the left at a discount rate, and then estimate the NPV. Let's go into the fertilizer business just as another example. In this case, $20,000 a year in sales, $14,000 a year in cost. 8 years, salvage value of $2,000. Project costs $30,000 today, so the initial cash outflow is $30,000, discount rate of 15%. Is this a good decision? Is this a positive NPV project? So we do a timeline once again. Any of these sessions, 6, 7, 8, 9, 10, and 11, you want to draw timelines. They will help you analyze these discounted cash flow analyses. And then you see the cash inflows of 20 per year for 8 years. Almost looks like an annuity, doesn't it? And then the 14 of cash outflow, and you get a net cash inflow of $6,000 a year. We have that salvage value out there near 8 of $2,000. So we think we can, after using it for 8 years, we can sell the equipment for $2,000. And then we have our cash flow totals at the bottom. Now, net present value will tell us to take these cash flows, discount them back to today at 15%, and then compare that to the cash outflow of $30,000. Now, if you look at the net inflows, they're 66666. That looks a lot like an annuity. So we can do a present value annuity on those cash flows and discount them at 15%. And then that $2,000 almost looks like a bond face value. We can take that back to today using the future value, present value formula. So the present value of the cash inflows is 27,578, and compare that to the cash. That's a cash inflow, and then the cash outflows are negative 30,000 today. So that's today versus today, and we get a negative 2422 as our net present value. So at the 15% discount rate, we have a bad investment here because we have negative NPV. Again, very simply, the NPV rule is, decision rule is NPV positive, good investment, NPV bad, NPV negative, bad investment. So just remember the NPV rule. Here's another example. Suppose we're going to look whether consumer products should be launched. You get 2,000 in the first few years, 4,000 in the next 2, and 5,000 in the last year. It will cost 10,000 today to begin production of this, and we're going to discount our cash flows at 10%. Again, we draw a timeline, show the cash flows coming in, and then discount them back, divided by 1.1, divided by 1.1 squared, 1.1 cubed, and so on. And then compare those cash inflows with the negative $10,000 of cash outflow today, and we see an NPV positive of $2,300, NPV or cash flow positive, NPV positive net of $2,300. So we accept this project.